Well, the new federal budget is out, nearly 500 pages long. That's a lot. Most of what came out is not going to matter to the average investor, but some of it definitely will. So in this video, I've pulled out 7 parts of the budget 2025 that I think will directly affect Canadian investors. So let's get right into it. I want to start with the open banking and stablecoin regulation. So Ottawa is finally officially moving ahead with the consumer-driven banking, also known as open banking. And this will give Canadians the right to have banks share their financial data with other banks or fintech companies. So what this means is when you want to switch banks, or if you want to switch investment dealers, instead of going through the painful process we've had to go to this point where you send them PDFs, for example, and doing everything manually, your financial institution will instantly and securely move your data to the new bank. So think of it like porting your phone number if you'd like to change that between carriers. Now, leave a comment if you are old enough to remember when moving meant that you needed to get a phone number, or when you changed carriers, you needed to get a phone number. Glad those days are behind us. Now, the Bank of Canada here will oversee the new system. It will tie into the upcoming real-time rail. That's Canada's instant payment network, expected in 2026. Now, on the digital asset side of things, the budget also sets the stage for stablecoin regulation. And for some people, that is a pretty big change. Now, this will require any token that's pegged to the Canadian dollar to be backed by real reserves and clear redemption rules. So if you invest in crypto, that means that there will be less regulatory uncertainty around fintech, crypto-linked companies, and possibly some new growth opportunities such as digital payments as they become mainstream. Probably something we can all agree on is that Canada's banking system has been notoriously conservative, and this is a real step towards opening that all up. Now, the second thing that caught my attention was the pension and retirement changes. Let's look at some of the updates that they have to our pension ecosystem. The government plans to align the federal public sector pension plans with the CPP and the QPP enhancements. And so that will reduce the employee contribution rates slightly, about $1,100 a year in annual savings per person. And that should save Ottawa around $1.1 billion over 4 years. Also, a smaller change that to qualify for the pensioner's dental plan, federal employees will now need 6 years of service instead of the current 2. That is expected to save another $100 million over the next 5 years. I know that might sound rather much like bureaucratic accounting to a lot of people, but the pension reforms, I think, often will ripple down into the markets. And when we think about the fact that Canada's pension plans are among the biggest investors in the country, then any shifts in contribution flows or plan rules can affect how much they allocate to equities, bonds, or infrastructure. So in other words, changes today, even though they might be small, could influence market liquidity and valuations down the road. The third thing is the modernization of banks and credit unions. And Budget 2025 also calls to make things a bit easier for smaller financial institutions. Some of the existing laws, they limit how much federally regulated banks and insurers could borrow or invest. So those rules are going to be scrapped and replaced with a more flexible oversight by the Office of the Supervisor of Financial Institutions, OSFI. So that means that a lot of smaller players will now have more freedom to raise capital, make larger investments, and that will potentially help them grow and compete with the big 5. The budget also takes aim at transfer fees. I really like this one, those annoying $150 charges or so every time you want to move an investment account. And the government proposes here that they will be banning those fees by 2026, also doubling the asset threshold that defines small banks and credit unions, so more of them will be able to benefit from the streamlined rules. Now, from the investor's perspective, that's where we're looking at this all today. The takeaway here is more competition. You got the cheaper switching methods, more flexible rules that could let smaller institutions expand lending and investment faster. Now, the fourth thing here, capital gains and small business incentives. And this is about keeping more when you sell. If you are a small business owner or you're a private investor, the budget brings a bit of good news. The lifetime capital gains exemption is being raised to $1.25 billion. That affects not everybody, but it does affect a lot of people. And the capital gains rollover provision here, that will let you defer tax if you sell shares in one small business and reinvest in another. So this is designed to keep entrepreneurial capital circulating instead of being taxed away at the moment that you exit a first company, which is the case today. Big winners here, they're going to be founders of companies and angel investors. And this could mean a lot of better after-tax returns for the broader market. It should mean that there's more capital staying in Canada's startup ecosystem instead of that money heading down south of the border. This, I think, is one of the few clear wins for investors in this year's budget. Now, number 5 is cracking down on tax deferral and avoidance. And the budget here tightens the rules around corporate tax deferral. So it's closing a loophole that lets companies delay taxes by shuffling dividends through a whole series of related corporations with different fiscal year ends. So that's something that's been used widely today. Under the new rules, you can't just pass the dividends along that chain and collect tax refunds until everyone has reported the income in sync. Also, a new rule here is under the anti-avoidance measures. It is for trusts to stop assets being moved around to get around the 21-year deemed disposition rule. Now, for regular investors, this isn't probably going to change a whole lot, but for private holding companies, for family offices, it will make tax planning more rigid, and it will limit these timing strategies that have been used just to reduce taxable income. To me, Ottawa's message is pretty clear here. It's going after some of these loopholes. Now, budget item number 6 relates to registered plans. And the government here is rewriting the qualified investment rules. And that is the list of what assets, what things you're allowed to put in your RSP, your TFSA, your FHSA, what those can legally hold. And right now the rules are scattered across different laws, full of expectations. It's a dog's breakfast. It's almost impossible to keep track. Now, some investments qualify for one plan now. They don't qualify for another starting in January 1st, 2027. That ecosystem will be replaced with a cleaner, more unified framework. So instead of a confusing sort of registered investment category, there's going to be just 2 types of qualified investment trusts based on existing securities regulation in plain English. If a fund is already properly regulated in Canada, it most likely will qualify automatically for registered accounts. Now, for self-directed investors, I know a lot of you watching this do your own DIY investing. That means that there will be fewer surprises for the fund managers, less red tape. So that is a small bureaucratic change, but it could make registered investing simpler and safer for everyday Canadians. Now, lastly here, one of the biggest headlines, I think, out of this year's budget is the productivity super-deduction. And this is a new rule that lets companies immediately deduct the full cost of new equipment, buildings, or technology that is used in manufacturing and processing in R&D. And this is big. It means that instead of taking that tax write-off and spreading it over 10 or 20 years like the current rules are, they can expense them right away. In this case, the government's betting here that that will spur business investment, especially in the high capital intensive sectors, industrials, clean tech, infrastructure. That's also a boost for the low carbon natural gas facilities. Projects that meet strict emission standards will also qualify for the faster tax write-offs. Put this all together, Ottawa says that these measures will cut Canada's effective corporate tax rate by more than 2 percentage points. That will give us the lowest tax rate in the G7. Now, for investors, I think this is a pretty clear signal here that Ottawa wants more domestic investment, and it's sweetening the deal for the companies that are willing to build and modernize right here at home. So hopefully this gives you some insights into what actually matters in the 2025 federal budget from an investor's point of view. If you did find this breakdown useful, let me know what you think. Do you think that any of these moves are actually going to make a difference for you personally? As always, I say thanks for watching. We'll see you in the next video.